So Netflix, they just made the biggest, the most daring move in their entire 27-year history.
Oh, absolutely.
And this wasn't just, dropping a new hit series. This was a ruthless, high-stakes business battle.
A battle's the right word.
And they won. They won a bidding war for what you can only call the crown jewels of Hollywood. It really cements their status, not just as a streamer, but as the world's new media titan.
It really does.
Okay, let's unpack this. We're doing a deep dive into this massive industry reshaping acquisition of Warner Bros. Streaming and studio assets from Warner Bros. Discovery, or WBD.
And this wasn't a quiet deal done behind closed doors?
Not at all. Our sources are detailing a full-on clash. You had rivals like Paramount, Skydance, Comcast, all of them fighting tooth and nail for this IP powerhouse.
And the scale of this whole transformation, it's just immense. I mean, for years, Netflix was the upstart fighting legacy media who, often just treated them like a nuisance.
Right.
In fact, there's that famous quote from a former Warner Bros. Boss. He dismissed Netflix as the Albanian army.
The Albanian army.
Yeah. A small, poorly equipped group that posed no real threat to the big media empires.
That quote is the perfect historical marker, isn't it? Because today, that Albanian army has basically defeated and bought a huge part of the establishment it was fighting against.
Precisely. They are now just strengthening their grip on the whole industry with the broadest global reach, the deepest pockets. With a market cap now soaring well over $400 billion, Netflix isn't just a streaming service anymore.
No.
It's consolidating its position as the world's largest entertainment company, and by a pretty significant margin. The hunter has become the undisputed apex predator.
Let's get straight to the numbers, because this is where the sheer magnitude of the deal really hits you. And it's also where the market is showing its immediate skepticism.
Okay, so we are talking about an acquisition that cost Netflix $82.7 billion.
$82.7.
It's billion.
That's the all-in price. And it's so crucial to understand what that number actually represents, right?
Yeah.
Because we heard that $82.7 billion includes debt. That's a massive detail that can get lost in the headline.
Absolutely. The devil is always in those financial details. If you strip out the debt that Netflix is absorbing, the equity valuation for the assets comes in at around $72 billion.
So that's a more than $10 billion difference.
Exactly. And that $10.7 billion difference isn't just accounting jargon. That is Netflix taking on the historical financial baggage and all the operational commitments of WBD. They're not just buying the good stuff. They're buying the complicated history, too.
And for WBD shareholders, that valuation works out to, $27.25 per share? A nice little premium over their previous closing price of $24.54.
It's a very respectable premium.
Well, let's clarify exactly what Netflix bought and, maybe more importantly, what they didn't buy.
Yes, that is the essential separation here. Before this entire deal closes, WBD's Global Networks division is going to be spun off.
Spun off into its own company.
Its own separate publicly traded company. So that means all those legacy Discovery assets, the cable channels like CNN and the Food Network, those are explicitly not part of the deal. Netflix is buying the studios and the IP. They are not buying the old school traditional media infrastructure.
They're buying the Ferrari, not the whole garage. And that distinction is pivotal, especially when we look at how the market reacted to such a colossal investment.
And what's fascinating here is the immediate market response. It is just dripping with suspicion. On the day the announcement broke, Netflix stock NFLX was down nearly 3%.
Yeah.
In really volatile trading. Yeah, it's this massive industry-changing win, and the market's first reaction is negative.
That is completely counterintuitive. Why the immediate show-me attitude from investors? What's going on there?
Well, it seems to suggest two core beliefs are driving that skepticism. First, they fundamentally question the long-term, the synergistic value of the combined company. And second, they believe Netflix might be substantially overpaying. The market's initial reaction was less congratulations and more of a very visible doubt that this price tag can ever be justified, especially when you look at history.
That sharp market doubt makes the optimism from Netflix leadership stand out even more, doesn't it?
For sure.
Co-CEO Greg Peters was quoted saying, "This acquisition will improve our offering and accelerate our business for decades to come."
A very bold statement.
Here's where the analysis gets really interesting, because you have this enormous optimism from the top, contrasted with a clear immediate fear from investors. It's a fundamental split on the perceived value that we really need to dig into.
Well, the value itself, if you divorce it from that price tag, is undeniably clear when you look at what they actually acquired.
Right.
Netflix now owns the historic Warner Bros. Film and TV studios, and crucially, the entire entity of HBO and HBO Max.
This is the strategic move they needed to truly go toe-to-toe.
Precisely. Historically, their acquisitions have been, minor complementary assets, a small mobile gaming company here, or the comic book maker Miller World there.
Tiny in comparison.
Reed Hastings, the co-founder, even said at one point, and this is a direct quote, "That's what made us successful for the last 14 years is we've done no M&A." He prided Netflix on growing organically.
So for the company that built its success on not buying its competitors, to suddenly commit $82.7 billion to this one acquisition, it really demands a deeper look at the core motivations. Is this strategic genius, or is it just a surrender to industry necessity?
I think it's likely a bit of both.
Yeah.
First, the opportunity itself was just too enticing to pass up. A legacy studio and content library this rich, it just doesn't come up for sale.
Right.
But second, it could absolutely be a purely defensive chess move.
The idea that they paid this staggering sum just to keep the assets out of the hands of, say, a Comcast or a Disney.
Exactly. You have to ask yourself, are they buying it primarily because they want it, or because they absolutely could not risk a rival getting their hands on Superman and Harry Potter?
And even if it's the latter.
Well, paying $82.7 billion is a profoundly high price to pay just to play defense.
It is.
And, whenever a deal of this magnitude happens, especially when a legacy studio changes hands, the ghosts of the media industry's past start to rattle their chains. Blockbuster mergers have historically been just fraught with pitfalls, and specifically, the assets around Warner Bros. Have sadly earned a reputation as a white elephant for several of its previous buyers.
And for those who might not know that term in a business context, a white elephant is an asset that looks beautiful and powerful on paper, like a historic studio or a massive IP catalog. But at the end of the day, it costs far more to maintain and integrate than the value it actually produces.
It's almost like a curse on that specific set of assets. We have these historic textbook examples of spectacular failure that directly relate to the content Netflix is now buying.
The most famous might be the AOL-Time Warner merger, forged right at the start of the internet age. That deal has gone down in business history as one of the worst executed mergers of all time.
And the failure there wasn't just financial. It was fundamentally a clash of cultures. You had the speed and, the flat hierarchy of the early internet world crashing into the slow, traditional, hierarchical structure of legacy media.
We couldn't integrate.
Not at all. They spoke different business languages, and the value just evaporated almost instantly.
And that destructive pattern didn't stop there. More recently, you look at AT&T's acquisition of Time Warner.
Another word.
It was supposed to be this grand integration of content and distribution, and instead it just resulted in billions of dollars in market value destruction for AT&T. It proved that scale alone doesn't solve complexity.
Even the immediate precursor to this deal, the current setup of Warner Bros. Discovery, has been a demonstrable market laggard since it was formed back in 2022. The ability to successfully operate these assets has eluded 3 major buyers in quick succession.
And we don't even have to limit this to just Warner Bros. Assets. I mean, even inside the streaming industry, Disney's acquisition of the Fox Entertainment assets is widely seen as a strategic disappointment.
It is.
Disney stock has underperformed compared to its rivals ever since that deal went through, largely because of integration costs and complexity.
Right.
So the takeaway for you, the listener, is absolutely clear. When Netflix co-CEO Greg Peters says this acquisition will accelerate their business for decades, he has to overcome decades of historical evidence suggesting that integrating these specific complex assets is nearly impossible without massive value destruction.
Right.
Execution is going to be brutally difficult.
And it is certainly not guaranteed.
Not at all.
And beyond the historical hurdles, there's the immediate practical reality of just getting the deal across the finish line. This merger still faces a necessary regulatory gauntlet.
Of course.
Because this deal represents such a massive concentration in the content market. Netflix controlling so much of the world's most valuable IP regulators are going to scrutinize this meticulously for antitrust issues.
And that scrutiny means we won't see this deal finalized anytime soon, will we?
Not a chance.
We're hearing that because of the size and scope of the necessary government review, the deal isn't expected to close until 2027.
2027. That is several years where the deal just hangs in limbo. That creates immense managerial uncertainty. We're looking at nearly 3 years before we can even begin to judge whether this was successful.
And until then, the merger creates more questions than answers about the day-to-day operation. There are two big operational and strategic uncertainties that really stand out right now, which are vital for Netflix's long-term identity. First, what happens to HBO Max? Does Netflix just fold that successful streaming service into its own platform, or does it allow HBO Max to remain independent as a separate premium brand?
And the risk there is cultural.
Right.
HBO has built its reputation on curated, high-quality appointment television, a quality over volume model.
Okay.
Netflix is famous for volume and binge watching. Can Netflix maintain that premium, curated feel that drives HBO's cultural cachet without just diluting it with the Netflix mass market approach? That's a huge internal challenge.
And second, there's the significant shift in their distribution strategy. Netflix has always favored a very limited theatrical release for its films, mostly just enough to qualify for awards.
Right, the bare minimum.
Now, they've stated they will continue to release Warner Bros. Movies traditionally in theaters.
That completely changes their historical model. Netflix spent years battling theater chains over the length of the theatrical window. Now they own one of the biggest suppliers of content to theaters. It forces them to manage these competing strategies.
Right.
Their core streaming business versus the legacy high-margin theatrical revenue stream from Warner Bros.
It's a huge paradox, isn't it? The timing feels so odd because Netflix's business has been, as our sources say, on fire lately.
On fire, yeah.
They certainly didn't need Warner Bros. To continue their success in the streaming wars.
Exactly. They were already winning the battle. But the inherent value, the brands, the studio, that massive evergreen content library, it sparked the bidding war for a reason. These assets have tremendous potential value, even if their recent history is, well, checkered.
The key is unlocking that potential.
Without destroying the value through a messy integration.
So what does this all mean for the industry in the long game?
Wow.
On one hand, Netflix is globally positioned with incredible business momentum. That theoretically makes them the best possible owner to finally leverage Warner Bros. Deep, untapped potential. They have the distribution network that others lacked. But on the other hand, the historical patterns of failed media mergers present this enormous operational and cultural challenge that even Netflix's scale might not be able to solve.
That tension is the whole story. Ultimately, since the deal's long-term success hinges entirely on execution, the fundamental question isn't whether Netflix can afford the assets. They clearly can, even with the debt. The real question is whether they can successfully monetize this massive content catalog while simultaneously keeping the distinct cultural cachet of the HBO brand intact for the next decade.
Yeah.
And that raises a really important question for you to mull over. Considering all those historical white elephants that came before them, what unique structural or operational innovations will Netflix have to introduce beyond just absorbing HBO Max to succeed where every previous buyer of these assets has failed? It requires not just integration, but a structural reinvention of how a legacy media company can operate profitably inside a modern digital behemoth.